UNITI Group, ticker UNIT, is getting some interest in the value community due to the fact it has sold off quite a lot, especially recently, hitting lows that it has not seen in quite some time. Now, I do have a request from a channel member, a freshly minted channel member, who specifically requested that I take another look at this stock. UNIT is a real estate investment trust that invests in communications infrastructure. Looks like specifically fiber optics lines. So this critical infrastructure type REIT can be pretty good in a lot of cases. For example, a lot of people love American Tower because, hey, they invest in cell towers, and as we know, cell phones probably aren't going away anytime soon, so that infrastructure probably has a pretty good amount of value to it. So one could draw the conclusion that perhaps this fiber optics communications infrastructure maybe has a similar sort of value to it, considering that fiber optics is important for a lot of high-speed internet and so forth. But there must be some reason why this is sold off, and I think it's important that we take a look at the financials to see if it's a worthwhile investment from a financial perspective. First things first, I'll look at the top line, which has been pretty stagnant over the last 5 years. Minor peaks and valleys, nothing to write home about. Nothing really standing out too much there, other than the fact like not really much growth. But growth isn't everything. If this was trading for 2 or 3 times funds from operations, for example, who cares if it's not growing? That would still be outrageously cheap. But I'm sure there's more to this story just than the lack of revenue growth. So I'm really curious to see maybe how the balance sheet looks, how leveraged they are, and a few other things, and we'll go from there. Also, in the most recent quarter, I think it's worth pointing out that there was a dilution event. Now, with flat revenue, I generally don't like to see share dilution, especially for a REIT where you would hope the dilution is used to perhaps intelligently grow their assets in a way that's accretive to shareholders. In this case, it doesn't seem like they've done that. Also, FYI, if they do keep the same ticker, it would be normal for them to have an increase in share count in the proposed merger that they have with Windstream. However, this merger is not expected to close until sometime in 2025, so that is not the reason for the dilution in this case. But speaking of that merger, supposedly it will create synergies and be a benefit to shareholders. Right now, they have more or less a landlord-tenant relationship. However, in this deal, the merger will combine UNITI's network with Windstream's business, creating a fiber provider. So it'll be end-to-end, the whole operation and the infrastructure owned under one company, serving 1.1 million customers in the Midwest and Southeast. It does look like they're keeping UNITI's CEO and CFO running the ship, the new combined ship, and unit shareholders will be getting 58% and Windstream 42%. So it does seem like more or less a unit takeover of Windstream in a stock deal, basically. So I do think this merger probably needs to happen. Something seems to need to change with UNITI. Their balance sheet is highly leveraged. They have over $5.7 billion of debt with only about 50-something million in cash on the balance sheet, meaning their cash to debt is extremely grim looking. While this is pretty normal for a REIT, when you combine it with the deeply negative shareholders' equity, which does result in negative book value per share to the tune of about $10, it seems a little alarming on the surface. I have had it put to me that the value of the assets is actually better than the book value implies. However, it would take a lot of evidence for me to be convinced of that, and the deficit that it would have to overcome. Again, this is like a $3 stock at this point, and the negative book value is $10 per share. meaning the negative equity would have to be off of the fair value by a whopping $13 or so per share to make this make sense from a net asset value perspective. And that doesn't even factor in the fact that the debt is growing. I'm also troubled by the fact that they're spending 50% plus in a lot of quarters of their revenue on Capex. In the most recent quarter, it was a good bit more than 50% of their total revenue on Capex, to not see that revenue meaningfully grow. So with a REIT, you would want this Capex to correlate with growing revenue, especially if it involves growing debt and growing share dilution. And this brings me to the dividend, which I would, if this wasn't a REIT, be extremely concerned that this wasn't sustainable. However, they did post FFO of 29 cents per share in the most recent quarter, with a quarterly dividend of 15 cents per share. So they've got almost 2x coverage on this dividend from their FFO, at least at current levels. However, I don't know if they would be able to keep this up after the Windstream merger. I don't know if they'll be able to hold on to their REIT tax status or if they even plan to. So if not, then they would have to pay taxes at the entity level, and then they may not be able to have such a beefy dividend payout at that point. That's just something to kind of keep in mind. On this one, it's not necessarily the dividend that I'd even be in for anyway, but it's something that I know would affect the share price if it changed. I think for me, what this comes down to is, what are they getting out of all that Capex? When does their revenue increase as a result, if ever? And are the assets really understated on the balance sheet to a degree that makes the current valuation make sense? I do think, hey, on a purely FFO basis, it does seem like they're trading at a pretty low multiple. But I don't think I fully understand at this point how the proposed merger that they're entering into is going to necessarily affect that, and therefore affect, how we might value it on a multiple basis. The assets, I think, are the key to this for me, and understanding them would be key. And frankly, it's a little bit outside my realm. I don't feel like I have a good grasp on that yet. If you have more insight on those assets or any other research on that merger and how it affects the tax status going forward, be sure to share in the comments below or hop on Discord. Link is in the description to share those insights with us. I'm always interested in hearing about different value-based stock suggestions and the research associated. Make sure you like, subscribe, and do all that stuff for the algorithm. Take it easy, everyone.